Hey, everybody, welcome back to another episode of Multifamily Investing with Charles Dobbins, your multifamily real estate attorney. And I am here with one of my most favorite clients. We just call him Raj. He's like Cher. Don't even look at his last name is Tekchandani, but don't just call him Raj. He's like Sting. He's like the rock star Sting. He's Raj. And let me read you his bio. And while I read his bio, I'm going to poke a little fun at him. So Raj is a seasoned technology entrepreneur. And just so you understand, a seasoned entrepreneur means he's over 50. Okay, yeah, that's the only way you become a seasoned anything. Who's now a full-time real estate executive, which is investor, which is really cool. We're going to talk about that transition for him. Now, prior to starting Smart Capital, okay, you heard the name, Smart Capital. We're going to be talking about that a lot today. He spent over 3 decades with tech startups in the field of business intelligence and data analytics, which is another cool thing we're going to talk about. He started investing in real estate in 2012 with the purchase of a single-family condo in Orlando, Florida. Yeah, how much you want to bet his family used that place quite a bit when it was vacant. He started because he's up in the Boston area, and everybody up here in Boston, we just can't wait to get the hell out of here down the south in the winter. In 2018, he left his W-2 after 5 years with a startup in big data analytics, machine learning, and artificial intelligence (AI), as we all know it, to pursue his interest in real estate, and stumbled upon the field of syndication and doing larger multifamily deals. And he started building the processes and systems of his company, Smart Capital, for apartment investing, the new AI for him. And that's what we're going to be talking about today, because I think he's doing it the right way. I think he's coming about this whole thing the right way. Now, he remains passionate about the use of data and technology in real estate, specifically as it relates to apartments, which is going to be cool. He's an angel investor, and he's involved in the early stage tech startups, and advises on product development to a couple of startups in real estate. He's got, I'm not going to read you his portfolio, but he's involved in 151 units, 225 units, 80 units. He just helped close a deal for 80 units in Kansas City. And this is the cool part. This is part of what he does. So if one of you are in the Boston area, listen up. He starts and runs a boardroom-style educational monthly meetup in Boston called the Apartment Investing and Multifamily Syndication, AIMS. Okay, so this is very cool. And as somebody out there looking to build your multifamily business and build your syndication and build your portfolio of potential investors, watch how Raj is doing it because he's doing it the right way. He's not just out there looking for deals. He's building up the other side of the equation as well. And besides that, and this is a problem for me, he's also an incredibly dapper dresser, so much so that when he shows up at my events, I always have to up my game because he's always look at him, I got the new Brooks Brothers stuff all over me. I do not recommend Brooks Brothers. It's not a good not a brand, not a good brand. And if anything, if you are looking to invest in any a company, do not invest in Brooks Brothers. Their products are getting poorer quality. And I was at an event, and I was wearing a Brooks Brothers a golf shirt with the golden fleece. That's their emblem on the thing. And there's like a 26-year-old millennial there, and she says, "Oh, now what's that an emblem for?" And I said, "Brooks Brothers." And she says, "Oh, what's Brooks Brothers?" I thought, man, sell your stock now. Get out. Don't ever find something on the internet. I came dressed today because I knew that Raj was going to be my guest. Raj, welcome to my podcast.
Thank you, Charlie. It's a pleasure. It's a pleasure. It's an honor, like I said, to be here with you.
Oh man! Well, wait until you might not be thinking that when we're done, but let's see how we do. Okay, so let's talk about. You have come about. You and I started working on deals together. I remember when you came to my first meeting, one of my Boston meetings, and we were talking about your property in Massachusetts, your multifamily property in Massachusetts, your first multi that you bought. And, I love what you said. He said, I wish I had spoken to you before because I would have priced that thing so differently, and why don't you tell people about that first experience?
Well, it was an experience, like you said. I mean, was jumping into this multifamily domain from doing single families in Orlando. Something came by right down the street on LoopNet, which our coach says never to look at, but just happened to be just down the street. And I was like, let me just go down there. It's a neighboring town, and it's upcoming town, and let's see what's there.
Well, let me just, for everyone who's listening, just so you understand, Raj lives in a very nice area, and then abuts a very not so nice area. And this property happened to be on the good side of the not so nice area.
Exactly.
But it's still,
you said it right. It's on the good side of not so bad area across my town line, which is great. I mean, all good. So yeah, I knew there was potential on this side of that town, and I said, let me take a look. And I went by, and everything looked good. The numbers look good, all stuff looked good. And what I said to Charlie when I met him, that after taking your course and learning from I would have priced it very differently, or maybe never done that deal.
Really?
Because there were so many red flags once I learned about multifamily doing the right way, that there was a lot of red flags.
Just so you know, there's a new podcast out there called Red Flag, Red Flag, Red Flag, and it's about dating people. And when you see red flags up, that's a red flag. I shouldn't like this guy. I should have my own podcast, Red Flag, Red Flag, Red Flag, about properties. So what went wrong? Well, or you still own the property and it's doing fine.
It's doing fine because exactly of the reason that I knew somewhat about that town, that if it was on the other side of part of the town, maybe it would have not done so.
Yeah, great.
So yeah, I mean, when we picked up the property, the rents were about $850. I rented that recently, the last unit at $1,300. So it's
that's great.
It's doing very well. I mean, like I said, the demand has gone up, and because it's on a decent street, it's on neighboring town, which is very nice town. So, but it took us a ways to go through that, and a bunch of vacancies, bunch of evictions, bunch of figuring out expenses that we had never figured out before I bought the property. Okay. I think that's what I was talking to you when I came to your second time. Said, Charlie, wish I knew what I knew now.
Yeah. So the NOI was
differently, or never bought it at all.
The NOI was not what it was cracked up to be.
Yeah, I mean, there were a bunch of expenses missing out of that.
Which forces you to overpay for the property.
Exactly.
Yeah. But good. Hey, listen, we all done it. My job is to keep you from doing it. But, anyone that's done this on their own, never had experience before, you're going to make the mistakes.
Right.
I'll tell you something, Raj. That's why you're on my podcast, because I don't speak to the people that have never made a mistake in their life, because those people are frauds. Tell me about your mistakes. That's where you learn in this business.
And I'm happy to. And, I share all these mistakes with everybody that I talk to now. Yep. You mentioned that meetup, and its meetup has grown tremendously. We'll talk about that later, how that has helped. But everybody that, brings up a deal, I said, look at the expenses, that C-class expenses at 30% expense ratio.
Yep, exactly. Yep. Exactly. I just analyzed the deal for one of our students this morning, and I love it when it says owner managed property. Yeah. Oh, so therefore there should be no management fee built into the numbers. And then you come out, it's a 30% expense ratio. It's like, oh, geez, I don't know. It's built in 1973. The guy was spending $127 per unit per month on per unit per year for repairs and maintenance on a 1973 property. Yeah, I don't think so. I mean, I'm not even a 1973 property, and I have to spend a lot more than $123 per unit per year on this body.
So yeah, I mean, there's a bunch of things that are not in the expenses. I mean, basic expenses like snow removal. Oh. I should have said, okay, maybe I was too naive then to say, okay, maybe that's figured out somewhere. And lo and behold, the first year of ownership of this property, it snowed so much. I was like, wow, what is going on? Where is global warming when I need it?
Yeah, you shouldn't have done what I did. I was getting killed. I spent $26,000 one year on snow removal on one of my properties. That just killed everything. I've got to solve this problem. I went out and I bought a Blazer, Chevy Blazer, like a 1980 Chevy Blazer with a plow, and I bought a sander for the back, and it never snowed again, Raj.
Yeah.
Until I sold that property, it never sold again. So that's called preventative maintenance. Just
Right.
buy a truck and it'll
So
never snow again.
just to your point, the guy was self-managing it, or his son was, and a lot of expenses were not there, which is weird. But
Yeah.
now we know better. Now we know better.
Exactly. Don't do that again. You never will. You never will. So then you and I started working together, and we looked at a bunch of deals, and and it quickly became apparent, that you weren't getting the numbers you were after. You weren't getting the deals you were looking for. You weren't getting the right deals. Which is, I don't want you buying 12 units in that town again. Let's think big here. And so you decided to go off in kind of a different direction. And instead of being the source for the syndication, you wanted to become part of someone's syndication.
Mm-hmm.
And tell me about that transition.
Like you said, I was out there, looking at banging on tools like Rionomy, trying to find owners, sources, but nothing was working, and, made a bunch of broker relationships. I got a few deals, but I figured out this is a team sport. I mean, this is absolutely a team sport. And you need to figure out what your role is. Are you the power forward? Are you the center? Or whatever you want to do. Yeah. By the way, Game 7 tonight, so.
I thought you were talking basketball.
I was talking basketball also, but that's Game 7 also. No.
And for those of you who are listening to this podcast 3 years from now, Raj and I are talking about our Bruins. Of course, there are Bruins when we're going into Game 7 of the against the St. Louis Blues. But man, I love hockey playoffs. It is so much fun. It is so much fun.
So not to digress too much, because I know there's people who.
No, hey, listen. No. We can talk about whatever we want, Raj. That's the beauty of this podcast.
The thing, we're both from Boston, so we love Boston sports.
Exactly.
Anyway, so there is no better thing.
And just for those of you that don't know, Raj actually has a North Boston accent. For those of you that haven't quite picked up on it yet, it's a North Boston accent. So, yeah.
I'm not wicked smart like Charlie is.
Wicked. First time I ever heard an Indian guy say wicked smart.
Yeah.
Learning
from the best. Learning from the best.
Exactly. Just stick around long enough. You'll sound just like me.
So, like I was saying that, this is a team sport. You can, figure out what you want to do and what are you good at, and quickly figure out that, my passion is either one, A, in deal analysis, using technology to do that, and B is to, educating and talking about what I do. And that led me to, people asking me more about, hey, what do you do? How do you invest? Can I invest with you? And that suddenly became a network, a growing network of people that I was not looking for money. At that time, it just became a network of people that I met frequently. I talked frequently about just, talking about what I do. And I was getting very passionate about the subject of syndication. So before even my first deal, I started blogging and writing on it, and, just going to meetups and meeting people and just talking about all of what I can do. And that led to, a network of people who, fortunately for me, are, I'm in a good place, and they're, all willing to invest, or not all, but most of them are willing to invest and just waiting for deals. So when the first deal came about from a group that we are part of, other members had the deal, and I said, let me get involved.
Yeah. And that was through the owner forum as well, right? You met that member through the owner forum. What town was that deal in?
So that deal was actually not my first deal. That deal was in Amarillo, Texas, that we're talking about.
Okay.
The 425 unit.
Yeah.
But prior to that, I was working with another syndicator out of the group, which also had a friend of mine had brought me a deal from him way back, which I had never invested. But I went back to him when I had all the education done on syndication to see what I can do. So invested passively as my first time around, and then quickly moved on to doing more active investments.
Okay, so essentially what I'm going to use this term, and you correct me if I'm wrong. And this term came about in one of our most recent Monday night phone calls with Mark Rios, who we're going to have on the program in the near future. But you kind of are becoming an aggregator. Is that right?
I don't know. Aggregator could mean anything, but
well, no. Okay, so in the sponsorship world, it's the guy that a sponsor of a deal can come to and say, "Hey, I need $1 million to close this deal," and then you say, "Let me go out to my stable of investors and see if I can sell you the $1 million, raise the $1 million for you."
So I did that for a couple of years, yeah. But I think that is just happenstance, but not intended to be an aggregator or a closer in this case. Like
Okay.
But yeah, I mean that's just happened to be that way.
Okay, cool. All right. So what happens when I come to one of your meetups?
Well, you'll find one thing is very different from any other meetups that you may be. This is a very small meetup. It's a boardroom style meetup, which we've been debating whether to grow it or not. But the meetup attendees that have come to various meetups, they said, no, let's keep it small. Let's keep it educational, informal, so we can just learn from each other a lot. So it's a 30-person, boardroom style meetup that we get together on a monthly basis and we pick up a topic. And I lead it off by saying what my experience is in that topic, whether it is market analysis or technology tools or just general multifamily, what it is, basics of syndication. And there'll be few people in the room who have never done anything syndication. They're just single family owners, but they get excited about it and they hear my story or other people's story, and they want to follow the path of that thing, and they come again. And after the meetup, I have like an open door policy. If anybody wants to meet me for coffee, I mean, that's the only reason I go to Boston. I have a shared office space there, gives me access to the conference rooms, and I'm busy meeting people who are following up on that meetup.
Oh, that's great. That's great. And so what's your purpose of doing that? To use these people as potential investors, or maybe just sponsor some of their deals if they put one together?
No, I mean, these are still people who want to learn syndication. I don't know. I mean, it's not, my intent is never to see them as, an investor. Some of them eventually invested alongside with me. But my intent is to just help out people who are either trying to make a switch from single family to multifamily, or from smaller multifamily to larger multifamily. I mean, that's my intent to, in this meetup. But it's just the nature of that. People, once you build that credibility and trust, and they see what you've done in your past deals, they say, "Hey, Raj, I want to invest along and I want to learn along with you." And
now, tell me about the last deal you closed. What role did you play in it specifically?
So my role for now is mostly being, capital raiser. So I mean, that's to your point, the aggregator or capital raiser. I have partnered with, I've leveraged, phenomenal people that I worked with, Mark, Ashley, people like that, Bob. And I've seen the deals, I've seen their analysis, and I've seen my value that I add to that deal. So in both these cases, I came in to raise capital. But I do my own analysis after they've done it, make sure that I'm comfortable with it. I look at every deal as an LP first. It's like, can I invest in this deal? And once that passes through, I say, okay, now can I add value by bringing more investors because I'm investing in it? I know the deal very well. Can I convince other people to invest alongside?
So you're obviously, like any type of salesperson, you got to believe in your product. So you first have to believe in the investment deal that these people are pitching. Let me ask you, what from an investment standpoint, from a property standpoint, what is it that you look for in the deal?
I mean, for now, I think I look at first the team. I mean, I've not done too many deals. So the deals that I've done, I've absolutely know the people who are doing the deals.
Yeah.
I've known their background. I've known their work ethic. I know how I interact with them. I've had, lunches, dinners with them. So I know the people very well, or that's what I want to believe. And then look at the deal secondly with the numbers and everything and the assumptions that they are built into it. And fortunately for me, these people are always willing to answer questions about, why is this? Why is this assumption? Why is that assumption? Yeah. And helps me understand the deal better, so I can then pitch to my friends and family instead of investors. Ahead.
Okay, so what type of terms do you look for? So once we get past the team brings you the deal. What types of investment deals, let's not talk about the terms of the investment. Let's talk about the property first.
Yeah.
What types of properties do you feel most comfortable pitching to your
Sure, clearly. So there is three types of multifamily syndication opportunities in my mind, maybe more, but one are the very stabilized one, class A, everything's hunky-dory, it's a yield play, invest in it and you'll get a steady flow of income. On the other spectrum is the distressed properties, a lot of value add, a lot of returns, but a lot of risk as well.
Yep.
So we keep away from those two end of the spectrum. So middle of the road is what we call, people would know, value add, class B or C plus, or something like that. Not very distressed in a growing market. So there is a whole set of market analysis that I do based on some of the tools that I have, technology tools that I have, subscribed to and engaged with. We very quickly find out more about the market, what's the job growth, income growth, the rent growth, what is the crime rate, all that other good stuff about the market itself.
Oh, okay. So that is really cool. So you're getting right in the middle. So essentially, you're looking for a performing asset that has some type of a management issue that you guys can get in there and fix.
Yes.
They haven't increased the rents, or they're in a great market, but they're not taking advantage of that marketplace. And yeah, okay, all right. So, all right, that's great. So that's a great type of property to look for, and like you said, C plus B minus, that area. And then of course, let's talk about the deal.
Mm-hmm.
So your team has found this deal. They put it together. They're now coming to you and say, Raj, from a property standpoint, this property meets your requirements. It's exactly what you like to see in a deal. Would you like to be in our package? Or would you like to be a member of our sponsorship? And then you got to look at the deal. You got to look at what are they giving up? I mean, I'll tell you something. Let me just tell you. And I just had a conversation with one of my students this morning where the guy, I had to tell him pigs get fat and hogs get slaughtered. And you can't be piggy in deals, especially, I mean, we just saw that last deal that you were a member of. There's, the sponsor took a haircut on it to make the deal happen. And in today's market, it's a seller's market. And everyone's trying to find the best deals out there. As sponsors, you got to take a little bit of a haircut now more than before. So what types of terms do you look for from the sponsors?
In terms of general partnership terms, or?
Well, no, as far as like, how much does the GP get to own? How much, what type of preferred returns? What type of, that type of, so we're talking about the property to get you excited about even talk. So essentially you've got three things that you're looking for. Does the team, are you confident in the team's ability?
Mm-hmm.
Does the property meet the criteria that you want to invest in, your own money?
Mm-hmm.
And then now the third thing is, okay, if I'm going to put $100,000 into this deal, what can I expect back?
Yeah, so good question. So I think I look at it from a very investor, sort of a limited partner perspective, right?
Yeah.
So what's in it for me? I mean, what's the split? Is it?
Okay, let me just stop you right there. Okay, this is fascinating to me because when we drafted our PPM initially to go out there and raise money, we had one page out of like 88 page, and you can find this on the resources and archives section. We had like an 88 page document, and there was one page entitled "What's in it for me?" Raj, what page do you think was the only one anyone ever looked at?
That page.
That page. And then I was teaching out in LA, and I had Jeff Lerman, he's an attorney out in LA, come in and talk about his deals. And he came in and he put up, guess what he uses to analyze his deals? He uses Doug Rutherford's cash flow analyzer, and he put the package up on the screen, but he added a page to Doug Rutherford's page entitled, "What's in it for me?" And it was like, no, I could not believe that here, neither one of us spoke to each other about the other's package, but we both knew that the most important question to answer when you're looking at any of these property packages, what's in it for you? Exactly. So make sure, if any of you listen to this podcast, you're looking to put together sponsorship, make sure you have that page in your package.
It's called the WIIFM,
What exactly?
that channel.
Oh, no, don't talk Twitter talk with me, man. I don't know Twitter talk. You do.
That's old talk, Charlie. That's before
before you turned 50. That was
Dude,
way
I'm
before you turned 50.
72 years old. You don't talk
I
to
know.
me that way.
You're double my age.
Yeah, I look good. You look like hell. So there you have it. You got to learn my shtick, man. So, go ahead, Raj. Tell us what you want as an investor. First off, because that's
exactly. So I look at the split. I look at the pref rate. I mean, I look at the cash on cash. I look at the IRR. I look at the last factor we look at is the annualized return. So those are all different terms. And
wait, hold on. What's that last term you look at? The annualized what?
Annualized return. So it's your cash on cash return over extended period, including exit.
Okay.
So yeah, I mean those numbers, and because there's different investors looking for different elements. I've met investors. They say, I don't care about your IRR, ARR number. Really care about cash flow.
Yep.
Because that's telling me, what I'm making year after year. I don't know when you'll exit, 5-year versus 7-year versus 10-year. Those IRR numbers are different. So really, that is down the road. I mean, of course, they have to have a minimums, but that their main focus is cash on cash. And the other people said, no, I need a minimum of 16% IRR. That's my cutoff rate. So we have to look at all those things. And I do look at all those numbers.
Yeah.
And
what do you like to see?
Sorry?
What do you like to see as your typical numbers?
So I like to see a cash on cash, over 8%. I mean, it used to be my threshold was 10% or 9, at least 9. But I think now I'm looking at deals between at minimum of 8 or 8 more than 8%.
Yeah.
And the IRR remains 15% or higher. Used to be 17%, but we're looking at deals that are 15% higher IRR.
Now, the part of this whole equation, and this is something I want people to understand, is that depending upon the strategy of the property, will determine whether it's a cash flow or whether it's an IRR type of return. Because I see these people who come to me with deals that are total value plays, total rehabs, and they're talking like, well, I can't get an 8% cash on cash return. Well, of course not. You're not making any money on the property. The whole point of this property is to drive the NOI, fix up all the units, spend your money fixing up the units, drive the NOI, and then getting the hell out. That's where you make your money on these deals. So don't even talk about the cash on cash.
You've got to understand and explain the business plan accordingly.
Yeah.
And that's
and that is, boy, I had a busy morning. I'm going to tell you about another student deal that I looked at this morning, where the guy sent me over his cash analysis, and the property when he was buying it was at 22% vacancy. That includes all the loss to lease and economic and physical and everything. So it's showing 22%, but the way he built his analysis was he kept his vacancy rate the same every single year going forward. I said, are you trying to tell me that, and you want to tell your investors that you're going to buy this property today at 22% vacancy and then maintain the 22% vacancy? Like, I don't think that's what the story you're trying to tell. And the problem that he didn't understand was the numbers have to tell the narrative. If your objective is to drive this property, increase the NOI, well, then show it to me in your numbers. And, I see a lot of new students making that mistake as well.
Right. I mean, like I said, in the value-add properties, there's no cash on cash in the first 2 years or maybe.
Yeah.
And you have to explain that to your investors. Hey, this is our plan.
Right.
This is not a stabilized property. This is a value-add property. The vacancy is going to go down further from what it is because of our plan. But
and I'll tell you, part of what you're doing with this meetup group is educating investors as to the power of multifamily, or as I teach, the power of the cap rate. I mean, if you teach somebody that you buy an A-class property, you put $1 in, you get 16 out. Okay, I get that, but if they don't know that when you're sitting down with them for the first time, asking them for their money, you've got to bring these people along in their knowledge of multifamily, and a lot of people just don't even bother doing that. It's so frustrating.
Yeah.
So, yeah. Okay. All right. So, Raj, let's talk about yours and my favorite topic, and that happens to be the analytics of multifamily. I love this business because the numbers just are so logical. They make sense. the microeconomics, the macroeconomics of a deal, the way you squeeze on one end of the balloon and it pops up over here. Everything just jives together. So let's talk about your background in analytics and how you're using it in multifamily.
So yeah, my background in analytics came from working in a bunch of startups, and the last one where we had, like I mentioned and you mentioned, it was in the machine learning AI space, because the data is now getting expanding on a rate that we can't even fathom. There's more data than we can handle. The Excel spreadsheets, forget the Excel spreadsheets, that still take care of a lot of analysis. But there is so much data out there, and some publicly available, some you have to pay for it. But the good thing is this technology has come a long way, that there are computers, machines that are ready to learn from the patterns that make sense in analytics, right? And that's how before real estate, our company was dealing with mostly pharma and financial services, and how basically data-driven decision making is what you used to say, D3M. And more data that you have and more algorithms that you can write, the better decisions you can come out with. It may not be 100% right, but at least gives you a good starting point. And I saw that coming out of that company and the real estate trying to do that, and I wanted to do more in finding out tools, or maybe writing some tool that day someday to do that analytics, and someday I might even do that. But there's tools that we are leveraging right now that do 60% or 70% of it. Tools like Inodo, a bunch of other ones that are still under the works. And I'm working with a couple of companies in the Bay Area that are also doing similar stuff, trying to be the next big company doing analytics for real estate.
Okay, now you mentioned one of my favorites, which is Inodo. I think Mark Rutson's doing a bang-up job with putting this information in a way that we, as smaller multifamily owner-operators, can use this information when we're making an offer. Because I talked about Doug Rutherford's cash flow analysis. That's a great static product. You put the numbers in, it spits out a number. That's it. Mark Rutson's tells you what's gone on with the rent on this property over the last 18 months. And man, that's phenomenal information.
That's just part of it. What Mark is actually working on and should be working on is what happens to the rent 5 years from now, based on what you're doing.
Yeah. Okay. So why don't we talk about that? Because what do you? Okay, Raj. I got just between you and me. I'm Connie Chung here. Just between you and me, what's going on in this market? What do you think is going on in the multifamily market? Because I had this conversation with a good Jillian Sidoti, and I talked about this, and we are seeing things that we don't like, and it's not something that you're going to see picked up in an analytical report. It's more, as lawyers, things that we have seen happening to big investors, and it concerns us greatly. So, talk to me. What do you think?
What do I think about what's happening or what's going to happen?
What's going to happen?
Well, what's going to happen is, the analytics and algorithms are going to get smarter, and they're going to and Mark is doing some of that. They take all the renovation improvements that are happening at a property. They quickly compare that, because everything is coming through property management systems like Yardi and all that stuff, where people are storing all that information. So we added the budgets, we added this, and this gives us this kind of rent bump in this zip code. So Mark and other companies are looking at that data and saying, hey, this zip code, 90210 or whatever you want to be, they had this multifamily, 100 units, and price per unit was this.
Can I just say for the record, it's very interesting that the Dapper Dresser chooses Beverly Hills zip code as an analysis. Okay.
I usually choose 02109, which is a mix of that. That's my zip code, and Boston.
Yeah. Oh, okay, fine, sure.
But I just want to keep it away. So Mark and other softwares are trying to, learn from all that data, that if you put in certain kind of, fittings, certain kind of improvements in a property, a unit, in certain kind of class of market, what is the rent bump that they can get in that market? And that data and all similar data on expenses and incomes and rentals is being mined. I mean, this is constantly being updated, and Yardi, and so much so that Yardi has come out with their own software Yardi matrix to, leverage some of that. So you'll see a lot more people coming to this, party and saying, okay, we want to leverage the data that is being collected on a daily basis, monthly basis. And anytime, you do monthly statements out of Yardi and, make sure the changes and the budgets and all that, softwares are looking at that and saying, okay, what's going on, and what are we expecting out of that? So, and again, they are so localized that they can tell you exactly in what market, what can happen.
Okay, but what about trends? It's not just rent trends, but even like population trends and that type of thing. So
yeah, same thing. There are softwares out there looking at census.gov, ctdata.gov. There are all these public sites that collect all that data. What are the neighborhoods? What's the median income? And for analysts like us, we look at that and saying, we want a certain median income in this neighborhood, because if you're saying that we are projecting a rent bump of $100 or $150, can this market or can this tenant profile take that rent bump?
Exactly. So that, I guess what you're saying is, with this type of data, going forward, we're going to be able to evaluate a deal and base our projections on more realistic projections, and know that, hey, this as an investment, this is a phenomenal one because here's why.
Yeah.
Or this one is not. You're not going to hit those numbers that you think you are, and here's why.
And theoretically, they should be like that. And there's still art behind that science that will require some of the experienced analysts to figure out what else, right? What are the assumptions?
Yeah.
Until the softwares get smarter, like the human beings, making those decisions. But we're going to get there. It's just.
It is. Go ahead. I'm sorry.
So when I found out about Inodo, I said, who else is out there? And I tell this story in my other, when I meet in meetups, that I started looking at, what is out there in the market. And I started, maybe I should tie up with somebody to, and I learned out there's a bunch of research done at MIT specifically on, software technology tools for real estate investing, and some for multifamily specifically.
Okay. Can you drop some names?
Names as in companies?
Yeah.
Inodo was definitely one of them. I have a full chart that I can share with you one day.
Okay.
This friend or colleague of mine, she was at MIT and she did a complete PhD thesis on this subject. And she shared that thesis with me. It's 150 companies all listed in one nice little chart as to who's doing what.
Wow. Okay. That's awesome. So, I mean, obviously you mentioned a couple of big ones, Inodo and Yardi. The new investors can tap into.
Reonomy is also up there, but slightly different space.
Yeah, exactly. And that's Reonomy.com, Inodoinc.com, and then Yardi. You all know Yardi, and you need a license sometimes to get into that information. But what's another one that? Well, there's Reis, obviously the Reis reports. I tell you, Reis used to be the REIS.com. That used to be the 900-pound gorilla in the room. And nowadays, man, I think they're getting their lunch handed to them. You couldn't afford their reports in the past, and now that data is out at your fingertips.
Yeah. And for the listeners who are interested, I'm also a member of what's called the CRE Tech. I think it's cretech.org or something. It's a consortium of commercial real estate technology people and MIT, and a lot of good stuff coming out of that organization.
Because as you know, we've already touched upon this. Raj is wicked smart, and that's why he taps into that so easily. So, Raj, I got to tell you, I'm sitting here looking at your backdrop, and it looks to me like you're sitting in front of a big building, there's a picture behind you of a big building with a whole bunch of little windows, like a manufacturer, like you're in Lawrence right now, and there's a mill building right behind you. And then I had I see the frame picture onto the right of it, and I realized that you're not trying to come up with some false background. But hey, it works for you. It works for you.
Do you want to know what the background is?
Are they coins? No, they're not coins. What is it?
Those are golf balls collected from all the travel golf courses that I've played at.
Oh, that's so cool. That's so cool. Hey, okay, then fine. And we'll wrap this up on this one question, because I got to play. Raj, I played last night. I had 5 birdies. 5 birdies. I was just out there goofing around. I hit my 36-inch from the cup on a par 3. I'm out there by myself, and I'm thinking to myself, man, that thing went in. Yeah, I was hitting the ball well. I said, that thing went in.
You need to get over to my clubs, Charlie. You'll have to play.
Oh, as a matter of fact, I just applied for a club today. But if that ball went in, I'd be buying a drink for myself. That would be it. It was unbelievable. I said, I can't do that anymore. And just for the record, I had about four birdies, but I was playing for the whites. I just didn't feel like, I was playing for the whites. I know.
That doesn't count then, Charlie.
When you're 72, that counts, okay?
I'll give you that.
Thank you very much. So, hey, Raj, listen, thank you so much for being a guest on my podcast. And I just want to close by saying to you, how can, if you're in the Boston area, how can people contact you, especially about this meetup? I think that's going to be the best way for people to reach out.
I think that's why I chose an acronym that is pretty catchy, AIMS, AIMS. If you look at meetup.com and look for AIMS, AIMS, which stands for Apartment Investing, Multifamily Syndication, very easy to find it.
Cool. Excellent.
Other than that, my email is raj@smartcapitalmgmt.com. Always happy to listen to get emails and reply back or meet up for coffee in the area.
Let me tell you something, Raj. I think once we publish this podcast, you're gonna be inundated. I mean, and listen, guys, you can't deal with a nicer guy, smarter guy, a better dressed guy than the share of multifamily, Raj. So, Raj, thank you so much for being on my podcast, and I will see you around town.
Absolutely. Thank you, Charlie. Pleasure.
And I'll talk to you soon.